for going concern. International Standard of Auditing (ISA) requires the auditor to assess the risk of going concern problems at the planning stage and during the final review. Assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal course of the business. Its assumption is an important assumption underlying the preparation of financial statements. An entity is assumed to be able to continue as a going concern for a foreseeable future period of time in at least 12 months beyond year-end date. In terms of going concern considerations, auditors' responsibilities are to consider the appropriateness of the use of a going concern assumption in preparation of financial statements and also to disclose in the financial statements any material uncertainties about the entity's ability to continue as a going concern. There are 3 indications that auditor need to be alert for the going problems, which are operating indications, financial indications and other indications. Auditors need to be alert for the going problems. The financial indications are net liabilities or net current liabilities, substantial operating losses, inability to obtain financing, adverse key financial ratios, inability to pay creditor when full due, discontinuance of dividends, change from credit to cash on delivery transaction with the suppliers and difficulty in complying with term of loan agreements. In terms of operating indications, there are loss of major market, franchise or principal supplier, shortage of important supplies and loss of management personnel. For the other indications, it is the pending legal proceedings against the entity. The steps to be taken by auditors are: first, evaluate whether results of audit procedures performed during the course of audit provide any indication events that may cause substantial doubt. Second, obtain information about the management's plan to mitigate the problem, if there is any substantial doubt. The third steps is consider the adequacy of disclosures with respect to uncertainty and include an explanatory paragraph in audit report.
In terms of mitigating factors, there are 2 factors where auditor can satisfy with. One of them is the indications liabilities exceed assets, which mitigated by management's plan to maintain adequate cash. Another factor is that indication loss of principal, in which it mitigated by availability source of supply. The normal audit procedure should be taken when a question about going concern arise. There are analyze cash flow, profit forecast with management, review events after the period end for item affecting the entity's ability to continue as a going concern. Review minutes that relates to financial difficulties and any action discussed to overcome the problem. Inquire of the entity's lawyer regarding litigation and claims, obtain letter for financial support. For audit conclusion and report, once the appropriate evidence accumulated, auditor decide the question about going concern has been satisfactorily resolved and consider appropriate report. The table shows the going concern assumption considered by auditors.
The tables show another going concern assumptions considered by auditors. If the result of the going concern is inappropriate, if not so material, it is disqualified, while if material, it is adverse. In the case where it is not resolved, auditors should adequately disclose in the financial statement about the uncertainty. If not so material, it is disqualified, while if material, it is adverse. Next, accounting estimates. Auditors should obtain audit evidence regarding accounting estimates. Allowance to reduce inventory and receivable to their estimated realizable value. Management responsible that sometimes simple and complex. For example, it is simple to estimate accrued rental expenses compared to estimate the provision of a slow-moving inventory. We move to related party transaction. Auditor must perform audit procedure to obtain audit evidence regarding related party transactions and effect to financial statements. Auditors obtain information from client upon completion of the audit and ensure proper disclosure in the financial statements. The example of related party transactions are purchase of sales of goods, property and other capital assets. Rendering and receiving services. Leasing and rental agreement. Transfer under license agreement. Financing agreement, which refers to loans and equity contribution in cash or in kind. Auditor need to obtain written representation letter from management concerning audit procedures. Process is, first, review last year working paper and identify related party transactions. Second, review minutes, corporate structure and discuss with management. Third, confirm with related party on terms, amount and transactions. Fourth, discuss with management the purpose and nature of transactions. And the last process is inspect documentary evidence in the possession of the related party.